When a market gets noisy, most people start chasing the wrong thing. They chase the stock that is up the most today. They chase the headline with the most heat. They chase whatever feels urgent enough to make them believe they are not missing out. I have learned to do the opposite. When a market gets noisy, I slow down and ask a much better question: who is actually getting stronger underneath the surface? Even if the price action is trying to distract me, that is how I want to frame this entire discussion. Because what we are seeing right now is not just a batch of earnings reports. It is a sorting process. It is the market separating companies that can justify their spending from companies that are asking investors for faith without giving them enough proof. And inside that same sorting process, you have one company that I think is being set up to become one of the more interesting long-term growth stories in the market. That company is SoFi. But before I get there, you have to understand the environment around it. The large technology complex just told us something very important. The AI spending wave is real, the capex is real, the cloud demand is real, the urgency is real, but not every company gets treated the same way when it spends heavily. Some companies are being given a blessing because they can point to obvious revenue engines that are accelerating fast enough to justify the spend. Others are being punished because investors can see the money going out but cannot clearly see why it has to be this much. This fast that distinction matters. Meta is the clearest example of the problem. The company is still producing powerful revenue growth. That is not the issue. The issue is that its spending has started to look like a man with a blank check and too much confidence. Meta's first quarter revenue rose 33% to $56.3 billion. But it also raised 2026 capital expenditures to a staggering $125 billion to $145 billion. When a company spends that aggressively, I do not merely ask whether revenue is going up. I ask whether the incremental spend is producing clear enough incremental proof. That is where things get messy. When your expense structure starts outrunning the calm story investors thought they were buying, the stock can get punished even if the business is still strong. That is exactly what happened, not because Meta is broken, because there is a difference between a great company and a great stock at a given moment. And the market is telling Zuckerberg that faith without clean line of sight economics comes at a cost. Now compare that with Amazon. Amazon's first quarter numbers were excellent in the places that matter most. Total net sales rose 17% to $181.5 billion. AWS revenue rose 28% to $37.6 billion, its fastest pace in 15 quarters, and advertising grew 24% to $17.2 billion. Now, Amazon is also spending aggressively. In fact, it is spending at a level that would make many investors faint if the company could not justify it. But Amazon can point at AWS. It can point at AI demand. It can point at enterprise demand that is not just hopeful, but already monetizing. That changes the conversation. The same thing is true for Alphabet. Alphabet's first quarter revenue rose 22% to roughly $109.9 billion, while Google Cloud surged 63% to $20.0 billion. You can spend a lot of money in this environment if the market sees a direct revenue engine accelerating behind it. Alphabet raised capex expectations because it can look shareholders in the eye and say, "This machine is already paying us." Microsoft falls into a similar bucket, though with a little less excitement than Google Cloud and AWS Azure. And other cloud services are still growing at a very strong clip. That is still a very strong business. It still gives investors enough evidence that the capex wave is tied to real demand rather than purely to ambition. Now, if you step back and look at all of that together, the short-term conclusion becomes obvious. A lot of this AI capex is not helping every spender equally. It is helping the suppliers first. That is why companies like NVIDIA, AMD, and Micron remain so powerful in the near to medium term when Meta, Amazon, Alphabet, and Microsoft all keep opening their wallets. The people selling the picks and shovels get paid before everyone else debates whether the spending was excessive. This is one of the simplest truths in growth investing. When an arms race is underway, the merchant selling ammunition often has the clearest economics. That is the first big lesson. But it is not the most interesting one, because the stock I want to focus on is not one of those obvious winners. It is the company that just delivered one of the strongest growth reports in the market and still got slammed anyway. SoFi, this is exactly the kind of setup I pay very close attention to. A company reports explosive growth, proves operating leverage, expands its customer base, prints real profitability, and the stock still gets hit hard because the market was positioned too aggressively. Expectations were too hot, or people are still too trapped in the older narrative around what the company is supposed to be. That is often where some of the best long-term windows appear. Now let us talk about what SoFi actually reported, because the numbers matter here. SoFi reported first quarter 2026 record net revenue of $1.1 billion. It added 1.1 million new members in the quarter to reach 14.7 million total members, up 35% year over year. It also reached 22.2 million total products, up 39%, and delivered net income of $167 million. Those are not cosmetic numbers. Those are the kind of numbers I want to see from a company that is still in the build-out stage and trying to prove that growth can become real earnings. This is where SoFi becomes interesting. A lot of fintech stories look exciting until you realize they were built on marketing spend, accounting tricks, or temporary cycle benefits. What I want is a company that is expanding its customer base selling more products, improving monetization, and moving toward a structure where the platform gets stronger as the ecosystem gets larger. That is the SoFi story in its best form. The company is not merely trying to hand out loans and pray, it is trying to become a much broader financial operating system for its members' banking, investing, credit, borrowing, saving. Financial products stacked together in a single relationship that matters, because the economics of a financial business improve dramatically when one user becomes several products and several products become stickier retention. That is why the member count matters so much. A business with 14.7 million members is not playing some tiny niche game anymore. It is beginning to look like a real contender. And when I think long-term, that is what I care about, not whether the stock is loved on one earnings day. I care whether the business is quietly becoming too important to ignore. Now, one of the more underappreciated parts of the quarter was the technology platform side. The market can get overly dramatic about the exact quarter-to-quarter movement in these platform account numbers, especially when exits or reporting changes muddy the picture. What I care about more is whether the broader ecosystem is still building toward deeper financial infrastructure rather than a one-product story. I believe it is. And that is one reason I think the market may still be underestimating what this company can become. But I do not want to pretend this is riskless. It is not. This is still a company operating inside financial services. That means it carries a different category of risk than a software business with near zero balance sheet exposure. If you buy a bank adjacent or lender adjacent model, you must respect the possibility that the wrong credit cycle, the wrong funding environment, or the wrong risk management mistake can hurt much more than people expect. That is why you can never treat a company like SoFi as if it were a no-risk compounding machine. It is not. It is a high-upside growth financial. Those are different words, and words matter, because when people hear next Palantir, they often imagine some clean rocket ship where the main difficulty is simply having bought early enough. That is not how this works. The better framework is this. Could SoFi become one of those stocks that spends years looking volatile, controversial, and misunderstood, while the underlying business keeps compounding until the market is eventually forced to re-rate it? Yes, that is the right question. And the answer is yes, I think it could. Not because it is literally Palantir, because it has the kind of long runway ecosystem expansion, customer growth, and operating leverage that can produce the same emotional pattern in the stock. People mock it, they doubt it, it keeps executing, they still doubt it, it executes again. One day they wake up and the stock is 3.5, or 7 times higher than where it looked obviously risky. That is how some of the great growth stories feel in real time, uncomfortable. Now let us talk about valuation and possibility. I am not one of those people who needs to tell you some stock is going to $100 tomorrow just to sound exciting. I do not care about that. I care about whether the business can become multiples larger in earnings power, product depth, and member count over the next 5 to 10 years. When I look at SoFi through that lens, the opportunity becomes much easier to see. The company has a very long member growth runway left. It has room to deepen product penetration. It has room to continue improving monetization. It has room to become more relevant in investing, banking, and broader financial services. And perhaps most importantly, it has room to keep proving that this is not merely a consumer lender with prettier branding. It is a platform business with multiple monetization channels. That is the heart of the bull case. Now, one of the reasons I like opportunities like this is because the market often cannot price them cleanly in the early years. Some investors still think in old categories. They call it a bank, or they call it a fintech, or they call it a lender, or they call it a story stock. And the truth is that the best versions of these companies become bigger than the box they started in. That is exactly what makes them worth owning early if you are right. Now, I also want to mention one more company from the uploaded document because it offers a helpful contrast: Cheesecake Factory. That is a completely different sort of investment. More stable, more cash, generative, less glamorous, less exposed to the AI capex insanity, and easier to understand. In a world where every big technology company is spending like it is trying to outbuild the future in one quarter. There is something refreshing about a business whose job is simply to serve food, expand sensibly, and return cash to shareholders. I respect businesses like that, but I do not confuse them with businesses like SoFi. Cheesecake can be a dependable, compounding story. SoFi can be a transformative one. Dependable and transformative are not the same thing. That is why I think the real portfolio work is not choosing one philosophy and applying it to every stock. It is knowing what kind of animal you are dealing with. Amazon is still always a buy in my mind because it owns too much of too many good things. Alphabet is no longer cheap enough to excite me as much as it once did, even though the business remains exceptional. Meta may have to suffer until Zuckerberg rediscovers some respect for capital discipline. Microsoft is still powerful, but the short-term cleanest upside may actually sit with the suppliers to the spend rather than the spender itself. And SoFi, in my view, is one of the more interesting long-term asymmetries because it is still early enough that the market is not fully treating it like the kind of company it could become. That is what I care about. Not just whether a business is good, whether the market still has room to be surprised by how good it becomes. So if you ask me what I mean when I say this, stock could be my next Palantir, I do not mean I expect a straight line up. I do not mean I expect no volatility. I do not mean I expect no fear. I mean that I see the ingredients of a long runway growth story that could look obvious only after the hard part of owning it is already behind us. And the hard part, as always, is living through the doubt while the fundamentals keep strengthening underneath. That is the bargain with great growth investing. You do not get paid because it was comfortable. You get paid because you saw the business clearly before the crowd was emotionally ready to do the same.